Good morning, everybody. Happy Tuesday. So glad that you can join us today. Very excited for episode 11. You guys, I've been very blessed with some really awesome guests. So every time I say I'm very excited, I actually mean that. So in a minute, I'm going to introduce our guest, but I did want to take a second. If you guys are already planning for 2 weeks out, in 2 weeks, we will have Sarah Foster. She is the principal U.S. economy reporter at Bankrate. And so she's been putting out some really interesting news reports and articles lately. If you guys haven't had a chance to check those out, head on over to her LinkedIn page. Very timely right now, of course, with everything that's been going on in the banking world. And so I'm excited to get her on the show in a couple of weeks. But today, without any further ado, I'd like to introduce our guest today, Mr. Lee Klaskow. And I think I got that last name pronounced correctly. So we'll go ahead and bring him on. Good morning, Lee. How are you?
I'm good. How you doing?
Good. I appreciate you making some time. I think you're on the road this week, right?
Later on this week,
Okay.
tomorrow, I'm heading down to Orlando to the TIA conference, which is the big freight broker conference.
Yeah. I know a lot of people at TIA. So anybody listening, if you're headed to TIA, be sure you say hi to Lee while you're down there. Lee, can you do me a favor and introduce yourself to the audience?
Certainly. So as Samantha said, my name is Lee Klaskow. I am Bloomberg Intelligence Senior Freight Transportation Logistics Analyst. For those that don't know, Bloomberg Intelligence is Bloomberg's research arm. We cover industries, we cover different asset classes like equity, fixed income. We provide strategy research. Um, so what I do for them is I cover pretty much all freight modes of transportation. So trucking, rail, ocean, air, and I also cover 22 individual names. They're usually the large publicly traded companies. Most of them are based in the United States. Companies like Union Pacific, FedEx,
Right.
JB Hunt, and also, some international names like Deutsche Post, Maersk, just to name a few.
Cool. Thank you so much for the introduction. I appreciate that. I've admired your work for a while now, and so I was very grateful that you agreed to come on and share a little bit of your knowledge with us. That's kind of the whole point of the podcast here is just to learn from people who know things that we don't. So excited you could join us. I'm gonna go ahead and kick it off because 30 minutes isn't a lot of time, and so a couple of the things that I like to touch on as much as we can on the show are the current state of the trucking market and specifically how macroeconomic factors affect the trucking markets. So, can I ask you first, since you're someone who's closely involved in research and studying and keeping up with trends and what's going on in these markets and macroeconomics, what do you think the macro environment right now is telling us about truckload demand in the truckload freight markets?
Yeah, so demand isn't great, and we got that kind of reinforced yesterday after the market closed when JB Hunt reported earnings. They noted that in the first quarter, their brokerage volumes were down around 25%, while their truckload volumes are down 10%. The weakness is really driven by what we would call difficult comparisons because last year,
Right.
things were going gangbuster. The cracks
Mhm.
quite weren't quite there yet that we're seeing today. And not only that, you're seeing a weaker economy. The Fed continues to move interest rates higher, trying to put the brakes on inflation.
Right.
Expectations are for the Fed to continue to increase rates, and obviously, it's all with the hopes of tamping down inflation, but that does have a knock-on effect where it could impact the economy. Usually when we see um, an inverted curve, meaning that short interest rates are longer or higher than longer interest rates, and you also have commodity shock, which we've had in the past. Usually, when you have those things together, a recession is soon to follow. And in Bloomberg, they look at a consensus estimates. They poll a bunch of analysts and economists out there, and right now, that's the probability of recession in the United States is around 65%, which is a pretty high.
Yeah.
The good news I would say that because if we do go into a recession, it probably will be more of a technical recession, and it'll be short and shallow, meaning that it won't be, like the financial crisis that we saw, which was, extremely painful. So it's a different kind of recession, but no one likes to say or be in the R word
I
because
was gonna say you
it,
said the R word so soon.
yes, yes,
Uh,
and then that has, what we're seeing is a knock-on effect, people getting laid off, which obviously are terrible for
yeah,
those people. But, a lot of the people that are getting laid off today, seem to be, people in the tech industry, and that
right.
seems to be a pretty resilient industry. So hopefully those people will bounce back quickly.
Right. Okay, so I'm going to ask a question specifically because we already brought up recession, so now I'm going to double back and ask a quick question. I remember at the end of last year, I attended a couple of conferences, and you weren't speaking, but there was people in kind of similar positions, some economists, some reporters, and they were speaking, and you had people who were just 100% sure that we were going to be in a recession. It was going to happen early this year, like it was unavoidable. And now we keep having people trying to say, like, hey, maybe we're optimistic. Maybe we're going to have a shallow one. You have people who are still holding out that we're not going to have one. Maybe they thought at least a month ago we were going to avoid one. So what what prolonged that? Like, what has drug it out thus far to the fact that we're still not able to like fully and completely say, yes, we are in a recession, or maybe we're going to be entering one? I feel like things are just progressing slower or kind of stalling, if that makes any sense. What are your thoughts there?
Well, the consumer is still relatively strong. They're still buying. They during the pandemic they saved a lot of money because they weren't going out, they weren't doing things, and so right now they're working through those savings. That you're receiving
Right.
savings, going down over the last couple quarters,
Mhm.
but they still have cash on their balance sheet, if you will. So a strong consumer is probably the biggest factor in delaying an all-out recession.
Yeah.
That's probably what I would say is the biggest thing holding it back. And unless the Fed is unsuccessful at creating a soft landing, meaning that we're not going to go into a huge recession.
Yeah.
I think that and again from a technical standpoint, a recession is probably likely, but again, it might be so mild that most people won't necessarily feel it in their pocketbooks.
Yeah. And I think that what's so interesting to me, and Jason Miller brought this up a few weeks ago on our podcast episode, was that the freight market can be in a recession without the actual economy being in a recession, so to speak. Like we can feel things differently in the truckload freight markets than maybe what the macro, economics are saying. Just for example, maybe services, like a spending on services increase that helps overall GDP, that helps bolster the economy, but it doesn't necessarily help dramatically increase freight volumes. So sometimes our stories are slightly divergent there too. And I think that a lot of people in the trucking space would say they've been feeling like they've been in a recession now for some months, even though if we might not technically be there as an economy. So what would you say about maybe certain sectors of the actual freight markets feeling it a little bit harder than others?
Yeah, so like just generally speaking, just to start off, Shelley Simpson from JB Hunt, she mentioned on their call yesterday that that we're in a freight recession, and I don't think that's a huge surprise to anybody,
Yeah.
just because when people talk about a freight recession, they're really talking about demand. They're not necessarily talking about revenue or
Yeah.
earnings. They're really just talking
Hmm.
about demand. Rail traffic is down 4% year to date. We've seen, trucking volumes down considerably. We saw a very frothy, robust spot market, a year ago, and people just don't need the spot market as much as they did, a year ago. And so you're seeing that market, not only drying up a little bit. And when I say drying up, I'm not saying it's going away. It's
Right.
going back to pre-pandemic levels.
Right. Right.
We're rebalancing and normalizing things. But when you're doing that against really difficult comparisons, it seems like doom and gloom.
Right.
The numbers that I said earlier, like JB Hunt's broker businesses, the volumes were down 25%. Their trucking business was down 10%. That's really, they were just really active in the spot market because
Mhm.
everyone and their mother was looking for capacity, because
Right.
capacity was very difficult to find because a there wasn't a lot of supply, and B, there was a huge wave of demand, just given the huge surge that we saw in e-commerce orders, and the retailers kind of being very strong during that time frame, just because people were like I said earlier, they weren't going away. So instead of spending their money on services, they were spending their money on stuff, and now we're reverting back to the mean.
Right. Yeah, and I think that also it's probably interesting that especially when we're looking at the results of these larger publicly traded companies, when all this excess temporary volume did come into the market the last couple of years, just by proportion, I mean, we know that those volumes were not going to be sustainable long term, that they were temporary. We had some record breaking levels of imports of truckload volumes moved for multiple months in a row for almost a year or 2 years. And you saw, of course, the larger companies who already had the scale and the resources be able to absorb a lot of that quickly. And so I think that that was also probably to be expected, unfortunately, for a lot of these bigger guys to have to shed not even shed that volume. It's just the volume itself is gone. Like, right? They're not giving it back. It's just waning now as we're returning back to this equilibrium, or what we considered a pre-pandemic more of a normal. So I think that it will be interesting too to kind of keep, like you said, historical comparisons in mind when we're looking at the results of these larger companies. Um, okay.
Yeah, yeah, and I would also say, we didn't touch upon inventory levels because of the supply chain dislocations that we had. People were ordering, like, it's trying to get as much as they possibly could because they couldn't keep the
Yeah.
shelves full. Then all of a sudden, as things normalize, they're stuck with all this inventory, and this inventory is slowly working off. And that's another thing that's leading to lower freight demand.
Yeah, I actually I'm gonna have this gentleman on in a couple of weeks for the podcast, but I talked to someone, I thought it was really fascinating because of the volatility of product availability in China during the pandemic, as far as like the restrictions for COVID and the lockdowns, and are we producing, are we not producing? A lot of companies who were still having to source products from China were just forced to buy as much as you could whenever you could, because
Hmm.
you didn't know if I didn't buy 4 months worth this week when they're open, if I was going to be able to get it in 2 more weeks. And so I've talked to some people like that who were like, look, we didn't have a choice. We had to do what we did, and we brought in a lot, and now we have full warehouses, and we're just going to have to sit on that for a while. And what happens is then you see, the international volumes are down a little bit from companies who are sitting on inventory. And then movement into DCs and out of DCs usually happens either on rail or truck. And so that's going to be slightly compressed too from people who just don't have to move additional inventory because it's already where it needs to be. So that's a great call out there with the inventory.
Yeah, and that's been driving, that change is just driving rates considerably lower. The container
Right.
liner rates are down 70, 80% from the same period last year. Trucking spot rates are down around 20%. Intermodal spot rates are down around 20%. So, it's not just lower volumes, it's also, lower rates, which is, squeezing a lot of margins out there.
Right. Okay. Speaking of margins and rates, uh, what do you have for me as far as maybe an update on spot versus contracted rates right now in the truckload space?
Yeah, so when you're looking, well, first off, so we do every quarter we do a survey with TruckStop
Okay.
on the truckload market, and it's predominantly obviously the spot market. And what we're seeing there, just speaking of the overall spot market, is that optimism amongst owner operators, which are obviously the main participants in that market,
Mhm.
has increased from the fourth quarter. It increased, to around 60%. Thinks that volume or demand is going to increase over the next 3 to 6 months.
Okay.
That's up around from 40% in the fourth quarter. But while it's encouraging because it's a lot that people are becoming a lot more optimistic,
Right.
usually from the the fourth quarter to the first quarter, there's usually a seasonal gain as we head into the summer season, but it's still below the first quarter average by about 500 basis points. So we're not where we were, but we're also moving in the right direction, which is encouraging. And I think a lot of that has to do with A, the summer season, and B, we are seeing some capacity leave the market,
Right.
which that market definitely needs to rebalance. So what does that mean for rates? Well, currently, we see rates are down around 20%. We think that there's a good chance that, we might hit kind of like the bottom. That's like at least our call sometime in the second quarter. We're not saying that it's good. They're not going to. We don't think they're going to just inflect like a V-shaped recovery. We think it's going to take time as more capacity gets weaned out and as demand improves. Which is
Mhm.
going to really dependent on those inventory levels coming down and normalizing. And again,
Yeah.
I'll probably for your listeners out there, every time I say normalizing, you should have a drink of something. Make this into a drinking game because that's really the key to the future is really what we're seeing. It's not really that the sky is falling; it's just things are just getting back to normal. Um, which is a good thing because it should provide you know people that are out there working within transportation, whether you own a truck or you're a Fortune 500 company, less volatility, more stability, which is something
Yeah.
that is important to plan your business.
Right.
um, so all that being said, I think I didn't really answer any of your questions, but you said on the contract side of the things, we think that rates are probably going to go down mid-single digits. When it's all said and done. That's obviously excluding fuel surcharges. It really, really what's going to base this on is like, when the bottom happens, if we're correct on, we're kind of touching that bottom soon. And also again, what's going to happen with the macro environment. And, as we talked about earlier, our kind of base case is that, any recession is going to be short and shallow.
Okay.
And so that's what we're looking for, um, at least over the next, 6 to 12 months, call it.
Yeah. I like what you said about, lessening the volatility because at the end of the day, we kind of think of it as people like to say, is it a shipper's market or is it a carrier's market? And honestly, if we're trying to find that good partnership where everybody's, we're taking care of each other is the idealistic situation everybody likes to think about. But when the volatility is so extreme, that's what makes it a little bit more combative, right? When the spot market is paying so much more than contract, or when contract is paying so much more than spot, or when there's so much more volume than there is supply. Like these are the things that kind of make this a little bit more difficult to navigate relationships, I think, in this industry. So really seeing things start to kind of stabilize, and we know that there's going to be fluxes in the trucking cycle. That's just how it is. It's cyclical. It's also based on times of year and consumer driven demand cycles. But we kind of see the graph going like up and down, like a little wave, right, over the years. But what we would really like to not see again is like this giant V, like you mentioned, because that was really what kind of threw everybody for a loop the last couple of years, is those unprecedented highs and lows that we're going through. I'm coming in still in one of those unprecedented lows when compared to how high we were not too long ago, right?
Right. No, absolutely. By the way, I liked your little dance move there.
Yeah, that's a
Yeah.
super high tech graph since
Right.
I haven't, don't have anything to share here today. We'll just hand motions.
Yeah, and,
Um,
and so I would also mention, when we were talking about rates, the reality is if you own a truck or you're a trucking company, your costs have gone up considerably,
right.
whether it's for labor, insurance, equipment, maintenance, and just because the spot market is down 20%, you're not going to see contract rates down that way. Because if you're a smart operator,
Right.
if your customers are trying to get that kind of price relief, they're just going to walk away from that business because to the ROI, to the return on invested capital, it just doesn't make sense. And so to have those strategic relationships where you're not turning the squeeze on the shippers when spot rates are up 50%, is probably the best way to go. And that's really what the spot
You don't
market,
say.
but But yeah, well, some people don't realize that. And
No, a lot
listen,
of people don't. You're right.
right.
Yeah.
And the spot market is the spot market. It's the price for if you need to ship something now, versus having that long-term relationship, whether it's an over-the-road relationship or it's a dedicated relationship, which has been a huge growth area for a lot of publicly traded trucking companies like JB Hunt and Werner. The dedicated JB Hunt's dedicated business was the only one that surprised on the upside. And they increased their fleet by around 7%. And they said their pipeline is moderating, but they still think they're going to make their target of about 1,000 to 1,200 gross new trucks this year, even with demand moderating, because shippers, going through the pandemic, really truly
Right.
understand the value of having that dedicated capacity.
Yeah. Yeah, I mean, I was just talking to just I got a lot of conversations with people on LinkedIn. I like to talk to the asset side of things as well. Um, I just was talking to a carrier the other day and said, "Hey, this I know there's a shipper right there in your backyard. Like, do you work with them? They'd be a good partner based on your network." And I think they're going through an RFP right now. I'll make an introduction. And he said, "Well, are they going to drive down rates dirt cheap like all the other shippers right now?" And I said, "Well, I don't know. Did you drive up your rates when all the other carriers did?" So it's like, hey, we're all just trying to find that that place where we can all kind of get along, right? But it is true, and I think you mentioned we're seeing a rebalancing of some capacity right now. We are seeing some people exit the market, and I mean, I had a guest on not too long ago. We talked about cash flow. We talked about the importance of cash flow in this space and managing those budgets and those costs when the market is paying well. When you were making good money, we're going to see the people who made the right investments and the right decisions for long-term growth, who will be able to hopefully sustain through this market, and especially if it's a more shallow recession and we're looking a little bit more optimistic. So, in some sense, I think that the rebalancing is going to be necessary, right? Because we're eliminating the people who maybe didn't quite figure out how to correctly handle the market cycles this last go around, and we'll be moving into the start of a new cycle with a
Yeah,
figured out capacity base. So hopefully everybody has it down this time, right? It's because of people
hopefully.
like you, Lee. It's because of this podcast that we're going to help people understand these things better. So appreciate you.
That's why I signed on. We were hoping to save some lives today.
Yeah, saving some lives today. Okay, so I wanted to bring up something because you talked about the earnings from JB Hunt, and I mentioned how that's a larger company and they have these assets. But correct me if I'm wrong, but I think that there's a trend where we're seeing even these larger asset companies and even mid-sized fleets for that matter, people with 500, 200, 1,000 trucks are starting to really try to work on expanding their what some people call asset light or their brokerage divisions. So amidst all of this, where you're saying people are really like shippers are enjoying the capacity that they're getting from these asset carriers, what's the driver behind all these companies trying to push more into growing a brokerage presence?
Well, I mean, I guess plain and simple, having a more diversified model, kind of reduces the shocks through the cycle. And
Right.
as time goes by, the cycles, as you mentioned, they come and go, but they're coming quicker and they're
Yeah.
lasting shorter. So
Right.
it's more whiplash that a lot of these pure play trucking companies are facing. But it also, if you're a broker, it's your return on invested capital. So the amount of money that that you're earning with your investments is a lot higher because you're not buying trucks, you're not buying trailers.
Mhm.
You're having a person probably in an office with a phone and a computer versus a truck that needs to be running all the time to make it worth your while. And if you have that truck, then you have headaches, right? Because you have maintenance. You have to have someone to sit in that truck and drive it, hopefully safely and professionally. And so it's just a matter of finance 101 is
Yeah.
being a broker has a higher return on invested capital, and also a lot of public companies are looking to diversify because those
Mhm.
those companies that earn a higher return on invested capital usually
Right.
get a higher multiple valuation, meaning that their stock price would be higher. So a lot of them do that to kind of, try to drive the price of the stock. And so, you're seeing a lot of transportation companies diversify away from the pure play truckload model. Again, JB Hunt's a perfect example. They started off as a trucking company, and then they built an intermodal business, and you know, um, then they had more of a they separated their over the road with their dedicated. Now they're in final mile, which is another non-asset light business. And so they're growing. JB Hunt wants to be an asset light transportation provider, because when you owning a container for intermodal is a lot less asset intensive than owning the truck and the trailer and all that goes with it.
Right.
So there's that movement. You have like a Knight Swift, who is probably considered from a management standpoint one of the best run trucking companies, truckload companies. They're like, one day they went into the market and says, now we're going to become an LTL carrier, so they're building a less than truckload network.
Right.
And that's pretty interesting. And again, the LTL is less volatile. It's more tied to industrial
Mhm.
production.
Right.
It's a much more consolidated market. The margins are much better. And so therefore, being in that business, while it is asset intensive, being in that business could drive, their stock's valuation. And again, in hopes of getting a higher multiple, because on average, an LTL carrier tends to have a higher multiple, or more steadier multiple than a truckload carrier.
Yeah. Oh, we got a little LTL in here. I like it. I like when we can talk about a little bit of LTL. That's how I entered this space, was in the crazy world of LTL operations. So
My
appreciate that. But
my
I
my first job in transports was I worked at an LTL carrier when I was in college. I loaded and unloaded trucks during the graveyard shift, which was a very hard job.
That see, I would have never guessed, but that's
Yep.
awesome. I my first entry position, I was a management trainee on a distribution center open air freight dock in January in Kansas City overnights. So all the guys like you that were working made fun of me because I ran around with like the only thing you could see was my eyes sticking out -4 degrees.
Yeah.
So but yeah, I mean, you learn a lot, right? You learn everything
Yep.
there is to know about LTL. Well, Lee, we are running up on time. I appreciate your time today. And can you let people know the best way to make sure they keep up with the information that you're working on, how you're publishing your research, and what you're finding? Like, what's the best way to connect with you and see the work that you're
Sure.
doing?
Sure. So the majority of my work goes across the Bloomberg terminal, which is a subscription only a product. Also, some of the work that gets fed into the .com, Bloomberg.com, and a lot of our reporters pick up the stuff that we're working on, so you could see that as well. But I'm pretty active on LinkedIn, and so please connect with me there. Also, semi-active on Twitter. I'm at Logistics Lee.
Yeah.
Pretty cool name, I know. And so you can follow me there. So yeah, so just I love talking to people within the transportation market. It makes me smarter, because I'm covering it
Mhm.
in my RV tower here on the second floor in Princeton, New Jersey.
Yeah.
But so it really helps. And if you're a TIA, please look me up. I'm doing a
Yes.
panel on consolidation on Thursday.
That's awesome. Yeah, definitely recommend people go follow you on LinkedIn and Twitter. I don't have a Twitter, so I kind of get like FOMO sometimes when we talk about it. So we'll see. I might break down and have to make a Twitter here soon, because I've seen some pretty cool stuff that, but I just see like the screenshots on LinkedIn instead of seeing it on Twitter. So I'll let you know. You'll be my first follow if I create a Twitter soon.
All
Uh,
right, sounds good.
Lee, thanks so much for taking some time and joining us today. And thank you to everyone who listened in today. If you had to jump in or out, or you just got in, this will be recorded and it is posted on just about everywhere, because I have a great producer, but Spotify, Apple, YouTube. You can also find it here on LinkedIn. Thank you, everyone, for joining us today for coffee.